So all macroeconomists in the US are focused on the Fed, and the Fed's got two goals for macroeconomic outcomes. It's full employment and stable prices. But all of last year, inflation was consistently below the Fed's 2% inflation target and consistently below most people's forecasts. So I'm here having a conversation with you, Alan, my colleague at UBS and our inflation guru. And I'm curious to hear how you think inflation is going to evolve this year and next.
So we see inflation moving up this year, up from 1.5% last year to 2% this year, and up to 2.1% in 2019. Not that much different than the rest of the street, but a little bit higher. What we're seeing is that tight labor markets are pushing up the inflation rate.
Has inflation got harder to forecast now than it has been historically?
Inflation these days is a pretty stable process, and the unemployment rate seems to push around inflation much less than it did, say, in the 70s, 80s, and even the early 90s. So on that metric, it is much harder to forecast today.
How can you be sure what's going to happen with inflation if the unemployment rate continues to fall? Is there any evidence of what happens when unemployment falls below 4%?
We're actually projecting the unemployment rate comes down to 3.25% by the end of next year. Very low by historical standards. Even as low as we saw in the 60s, slightly below that. So if you look at the 60s period, you see the inflation rate started to ratchet up in the late 60s as the unemployment rate stayed very low.
So I think one big question on lots of people's minds, though, is we've had an economy that's been growing now for many years. We've had an unemployment rate that's been falling now for many years. And then at the end of last year and the beginning of this year, we had a big pickup in fiscal stimulus. We had massive tax cuts at the end of last year, had a massive increase in the allowance for federal spending. How does that change in the outlook for fiscal policy change your view for what's going on with inflation?
That has driven our forecast for the unemployment rate down a little bit more than 0.5 percentage point from what we had it before we saw that massive fiscal stimulus. Now that 0.5 percentage point is really important when you're getting down at such low unemployment rates that we have these days. And also we're now expecting a pickup in the labor force participation rate. So a lot of people that have been outside the labor force are now coming back into the labor force. So this puts a significant upward pressure on wage growth with the unemployment rate that low, and a lot of extra disposable income by people, which should lead to increased consumption, pushing up prices. So that fiscal stimulus is a big risk to the forecast, not in the near term, because we're seeing a lot of this increased income growth, but then later in 2020, when a lot of this fiscal stimulus comes off, and with the Fed tightening rates, we're seeing a significant probability of a recession out in 2020, out in 2021.